Welcome back to the Deep Dive. Today we are cracking open a company that, honestly, it forces you to rethink what a Japanese manufacturer actually looks like.
It really does.
Yeah, because you pull up the ticker, 6284 in Tokyo, you see NISSEI ASB, see the headquarters in Nagano,
Yeah.
and you see pictures of heavy machinery.
Right. And if you stop right there, you miss the entire story.
Exactly.
Because on paper, this is a very polite regional machinery company. But in reality, it's almost like a geopolitical hedge fund disguised as a plastic bottle maker.
Which is a massive claim.
Yeah.
But looking at the research for this special edition of our Japan Stock Podcast series, I see exactly where you're coming from.
Yeah.
This is a company that is effectively an Indian industrial giant just wearing a Japanese trench coat.
That is the perfect way to describe it. We are looking closely at NISSEI ASB today. And the reason we're doing this deep dive right now, recording this in late February 2026, is because they are putting on a total masterclass in global strategy.
Yeah, they really are.
They're navigating a crumbling Chinese market, and even more importantly, they are dodging U.S. tariffs with a level of logistical gymnastics I have rarely seen in my career as an analyst.
We are definitely going to get into the tariff hopscotch a bit later because that part just blew my mind.
Oh, it's brilliant.
But let's ground this first. For everyone listening, we're talking about plastic bottles.
We are.
But not the bottles themselves. NISSEI ASB doesn't sell plastic. They sell the machines.
Be correct. They sell the hardware. Specifically, they sell one-step injection stretch blow molding machines.
Okay, definitions first. One step implies there is a two-step. What is the standard here?
So the industry standard, what you'd normally see with massive companies like Coca-Cola or those huge high-volume water bottlers, is usually a two-step process.
Right.
In step one, a massive machine injects plastic into a mold to create a preform. It basically looks like a thick test tube, and you can ship those test tubes anywhere.
Because they're small and durable.
Exactly. Then, in step two, a totally different machine at a bottling plant heats that test tube back up and blows air into it to stretch it into a bottle.
So it's basically shoot and ship. You make the test tubes one place, throw them in a truck, and blow them up later.
That's it. It's super efficient for just massive volume. But NISSEI ASB specializes in the one-step method.
Which means it all happens at once.
Right. Their machine takes the raw plastic resin pellets, melts them, creates that preformed test tube, and then while it's still hot, immediately stretches and blows it into the final container. All inside one single machine.
So there's no cooling down, no shipping the test tubes and boxes.
No. And that matters for two huge reasons. One is energy. You don't have to reheat the plastic from scratch, which is a massive deal when global energy prices are volatile.
That makes sense.
And two is aesthetics. Because the plastic never cools down and hardens completely, you don't get the scuffs or those minor scratches that happen during transport. You get a pristine, crystal clear bottle.
Okay, so if I'm selling generic spring water at a discount store, I really don't care. I'll just use the two-step.
Yeah, you wouldn't spend the money.
But if I'm selling, high-end cosmetics, expensive iced tea.
Exactly. Cosmetics, pharmaceuticals, baby bottles, or even those wide-mouthed jars for premium peanut butter. That is NISSEI ASB's kingdom.
Got it.
They aren't trying to beat the giants on speed for cheap water bottles. They are winning on precision and beauty for high-margin containers.
Okay, so we have the tech down. Now let's look at the map. You mentioned earlier this is an Indian company in disguise.
Right.
I was looking at their history. They built their main factory in Mumbai, ASB International, back in 1997.
1997. Just let that sink in for a second.
I mean, today, every business consultant in the world is yelling about India strategy or China plus one. NISSEI ASB was already there 30 years ago.
And that right there is their structural moat. This isn't some hastily built factory to avoid a sudden tax hike. They have spent 3 decades training local engineers, building up local supply chains, and refining costs in Mumbai.
It's totally embedded.
Completely. It means their cost basis is fundamentally different from any Japanese competitor who is just now trying to break into India. They aren't renting space. They own the entire ecosystem.
And it's not just the factory floor either, right? I was looking at their management structure. The current global president, who took the reins in December 2023, he isn't your typical Tokyo salaryman who came up through domestic sales.
No, he isn't. And this is a detail that retail investors often miss, but institutional investors pay very close attention to. The current global president was previously the president of the Indian subsidiary.
Which feels incredibly rare for a traditional Japanese manufacturer. Usually the overseas guys well, they're just the overseas guys. They don't get to run the mothership.
It is almost unheard of in Japan. It sends a massive signal to the market. It tells you that the board realizes the power dynamic has completely shifted. Nagano might be the brain for R&D designing the complex machinery, but India is the heart, the muscle, and honestly the wallet of the company. Promoting him basically says, we are an Indian manufacturing company with Japanese engineering.
Okay, so keeping that unique structure in mind, headquarters in Japan, massive engine in India. Let's look at the numbers. We have the FY 2025 recap and the Q1 2026 data. How is business actually doing?
It's a bit complicated, and to understand it, you have to understand a quirk in their accounting called the shifted indicator.
I saw this chart in reports, orders versus sales, and they don't line up at all.
Right, they don't. Because these are custom multi-million-dollar machines, there is a massive lead time. NISSEI ASB operates on roughly a 6-month lag. So the sales figure you see in the financial report today is actually a reflection of the orders they took 6 months ago.
So if orders are super high today, the stock might not reflect that in actual earnings until next autumn.
Precisely. It gives you a sort of crystal ball if you know where to look. So looking at the FY 2025 recap, they hit record highs in total orders.
So
Apple.
Record highs are usually a good thing, yeah.
Usually. But if you peel back the layers, the mix of those orders is weird. Orders for the actual machines, the big capital expenditures, actually went down.
Wait, how do you hit a record in total orders if you are selling fewer machines? That math doesn't seem to add up.
2 words. The mold.
The mold.
The heavy metal cast that determines if the bottle is square, round, or shaped like a bear. Mold orders absolutely surged. And this is the hidden beauty, the classic razor and blade model of their business.
Oh, I see. So the economy might be shaky.
Uh-huh.
A customer might say, hey, we aren't spending $2 million on a new machine this year.
Exactly. The CFO cuts the CapEx budget entirely.
But the marketing department still needs to launch their special summer edition iced tea. Or they need to redesign the shampoo bottle because a competitor just launched a cooler one.
Bingo. So they have to buy a brand new mold to put into the old machine.
And I'm guessing molds are high margin.
They are pure profit drivers. So even when the machine sales, the actual hardware, dipped, the mold business acted as this incredible shock absorber. That is exactly what saved their FY 2025 numbers.
That makes the business incredibly sticky. Once I buy your machine, I am basically locked into your ecosystem for the molds forever.
Exactly. It is a recurring revenue stream that behaves totally differently than the volatile machine sales cycle. And right now, in Q1 of 2026, that mold demand is holding steady, particularly in Japan.
Which tells us what?
It tells us that even if companies aren't expanding their factory capacity, they are still fighting for supermarket shelf space with new designs.
Okay, so the mold economy is their safety net. But let's look at the growth regions. I'm looking at the regional breakdown now. Japan is steady, but there is a lot of green ink in the Middle East and Africa.
This is a really interesting recovery story. For the last few years, geopolitical conflict made investment in that region very difficult. But the Q1 reports for 2026 cite conflicts easing as a primary driver for a bounce back.
Is this just general corporate optimism, or are they actually shifting units over there?
No, they are actually shifting units. We are seeing specific interest in models like the PF36 and the PM90.
Why those specific models?
Well, the PF36 represents their new generation of efficiency. When you see specific model numbers popping up in a region, it means the R&D team in Nagano actually solved a very specific problem that market cares about.
What's the problem in the Middle East?
Electricity and resource management are becoming huge issues. The PF36 likely offers better energy efficiency or speed for specific bottle types, probably water or edible oils, which are very high volume in the Gulf.
Okay, so India is the production engine. The Middle East is the recovery story. But we have to talk about the two massive giants in the room. Let's start with the problem child.
China. The reports are just brutal. They consistently rate the Chinese market as weak or sluggish, all the way from late 2024 right through to where we are now in 2026.
No sugarcoating it at all.
None. And it makes perfect sense. You have a general economic downturn there, but you also have fierce local competition.
Right.
If you just want a simple machine to make a standard water bottle, a domestic Chinese manufacturer can sell you one for a fraction of the price of a NISSEI ASB machine.
So NISSEI ASB just can't compete on price there.
No chance.
Yeah.
The local machines are good enough for commodity products, so do they pull out? No. They retreat upmarket. They are pivoting entirely to high-value niches in China.
Like what kind of niches?
Things like bag-and-box liquid containers. Think of wine boxes or bulk liquid shipments. Or complex two-layer containers.
Layer, like a thermos.
Sort of. Imagine a ketchup bottle where the inner layer prevents oxidation so the ketchup stays bright red, while the outer layer provides the rigid structure.
Oh, wow.
That requires a level of engineering precision getting two different plastics to bond perfectly in one step that the local, cheaper competitors just haven't mastered yet.
So they are skimming the cream off the top of the Chinese market and leaving the regular milk for the locals.
Correct. But frankly, China is not the growth story here. It's pure damage control. The real story, the one that really highlights the absolute genius of this company, is happening in the United States.
Yes. This is the tariff gymnastics section. This is what I really wanted to get into today. Because reading this, it feels like the plot of a movie about supply chain management.
It is fascinating. So let's set the scene. You have a Japanese company. They make their machines in India because it's highly cost-effective, and they want to sell them to the U.S. because it's a massive, lucrative market.
But the U.S. has high tariffs on Indian goods.
Right. If they ship a machine directly from Mumbai to New York, the tariff bill just destroys their margin. They might as well not even sell it.
So most companies in that situation would just, what, eat the cost?
Or raise prices. Or move the factory entirely. But NISSEI ASB found a loophole, or rather a highly complex logistical workaround. For their most popular machine, the 70DP, they stopped shipping it from India to the U.S.
Okay.
Instead, they manufacture the parts and the modules in India. They put them on a boat, and they ship them to Japan.
To Japan.
To their factory in Nagano. They assemble the final machine in Japan. Now, under international trade rules, because the substantial transformation, meaning the final assembly happens in Japan, the machine legally becomes a made-in-Japan product.
And made in Japan has a much lower tariff rate coming into the U.S.
Exactly. They ship it from Japan to the U.S., bypassing the India tax entirely.
That is wild.
Yeah.
They are physically moving the assembly line halfway across the world just to change the sticker on the crate.
Pretty much.
But wait, shipping heavy iron from India to Japan, unloading it, assembling it, reloading it onto another boat, and shipping it to the U.S. cannot be cheap.
It isn't. The company estimates this adds about 300 million yen in logistics and assembly costs for the year.
300 million yen. That is a significant chunk of change.
It really is. But you have to weigh it against the alternative. If they passed the U.S. tariff costs on to the American customer, the price of the machine would jump so high they would just lose the sale to a European or American competitor. So they eat the 300 million yen in logistics to keep their market share intact.
It really challenges the definition of efficiency, doesn't it? Usually we think efficiency means the shortest straight line between 2 points.
Yeah.
But here, the most efficient route financially is this massive, globe-spanning detour.
It is, and it highlights that in 2026, manufacturing tech isn't just about how fast the robot moves on the factory floor. It's about how agile your logistics team is.
Yeah.
Most companies just talk about supply chain resilience in PowerPoint slides. NISSEI ASB is actually doing it. They are toggling production routes between India and Japan based purely on who is taxing whom.
Is every single machine doing this world tour now?
No, and that's a very important distinction. Take the 150DT machine, which is another bestseller. That one was already being made in Japan from the start, so that one is totally unaffected. It's just business as usual.
They're selective.
Very. It's only the models that were exclusively Indian that are taking this detour. This shows they aren't panicking. They are surgically altering the supply chain only where it's absolutely necessary.
It's a brilliant dual-track strategy. But I have to play devil's advocate here for a second.
Yeah.
This sounds clever, but isn't it also incredibly risky?
How so?
Well, you are betting your U.S. profit margin on a legal loophole. If the U.S. government decides to change the substantial transformation rule, if they suddenly say, hey, 80% of this machine is Indian parts, we are taxing it as Indian, regardless of where you put the final screws in, the whole strategy collapses overnight.
That is the multi-million-dollar risk. You are absolutely right. They are betting heavily that the trade rules hold as they are currently written.
Right.
If protectionism gets stricter, or if that Made in Japan label gets scrutinized more heavily by customs, this 300 million yen workaround could easily turn into a dead end. This is the single biggest political risk variable for the company right now.
So looking at the next 1 to 3 years for NISSEI ASB, we have the Middle East recovering. We have China struggling but pivoting to high-end. And we have this complex India-Japan-U.S. triangle. What determines if they win or lose going forward?
I think it comes down to two main things. First, does the Middle East recovery actually hold? They need a solid growth engine to replace the stagnation in China. If the Middle East destabilizes again, they are in trouble because they can't rely solely on the US and Japan markets.
And the second thing?
The second is exactly what you just pointed out, the durability of this trade loophole. Can they continue to leverage the India-Japan arbitrage? Right now, it works beautifully, but trade policy is incredibly volatile.
Yeah, changes with every election.
Exactly. If the U.S. cracks down on transshipment or reassembly, NISSEI ASB will have to make a hard choice. Do they bite the bullet and build a factory in the U.S., or do they just accept much lower margins?
Which would be a huge CapEx decision.
Yep.
Building a factory in the U.S. is a lot more expensive than paying for some extra shipping containers from Tokyo.
Exponentially more expensive.
Mm-hmm.
And that brings us to how they treat their money. We've talked a lot about global trade wars and industrial strategy, but I saw something in your notes about a lottery.
Oh, the shareholder engagement thing.
Yes, the Kokiku survey.
Kokiku. That translates roughly to, we listen to your voice, right?
Roughly, yes. It is their specific shareholder engagement strategy in Japan. They send out this survey to retail investors asking for feedback on the business direction. And if you take the time to answer it...
You get a special dividend bonus.
No, you enter a lottery for a small gift.
A lottery for a small gift. Like, what, a tote bag or a pen?
Probably something like a hand towel or a calendar. It is just such a wonderfully traditional Japanese corporate detail.
It really is an amazing contrast. On one side of the globe, you have this company playing 4D chess with U.S. customs and Indian labor laws. And on the other side, they are politely asking you to fill out a paper survey for a chance to win a hand towel.
It keeps them grounded, I suppose. It shows they still care about the everyday retail investor in Japan, even if their strategic eyes are fixed on Mumbai and New York.
But it's just a small gift, right? The actual shareholder return policy is solid.
Oh, absolutely. Don't let the small gift fool you. This is a very serious, sophisticated operation. Their dividend decisions are formally delegated to the board, which means they can react very quickly to cash flow changes. They are conservative, but they are smart with capital allocation.
So let's summarize this deep dive. NISSEI ASB, not just a regional bottle maker.
Not at all. It is a company that has successfully decoupled its cost base, which is in India, from its brand identity, which is in Japan.
Right.
It is using high-margin mold sales to weather economic storms, seeing the razor and blade model in action. And it is literally rerouting global supply chains to dodge tariffs.
They are agile, they're profitable, and they're incredibly clever, but they are walking a tightrope on international trade regulations.
Exactly. They're basically betting they can move their ships faster than the politicians can write new rules.
So here is a final provocative thought for everyone listening to chew on. We look at NISSEI ASB's incredibly complex structure, the India factory, the Japan HQ, the U.S. sales, parts shipping back and forth across oceans, and we applaud it. We call it resilience. But at what point does resilience just become inefficiency?
That is the ultimate question here.
If global trade barriers continue to get higher, does NISSEI ASB's dual structure become their biggest, most expensive liability? Or is this immense logistical complexity the ultimate insurance policy that no competitor can even afford to copy?
Most competitors are stuck in one country. ASB has options. But as we saw with that 300 million yen logistics bill, options cost money. The next 3 years will tell us if that insurance premium actually pays off.
Definitely something to mull over next time you pick up a pristine plastic bottle. That is going to do it for this deep dive into NISSEI ASB. Thanks for listening, everyone.
Goodbye.